Great. I'd like to call to order the Marin Municipal Water District Finance Committee meeting on November 20th, 2025. May I have a roll call, please?
Good morning, Vice Chair Diana Mayer
Here.
and Chair Jed Smith.
Here. Any public comments on non-agenda matters?
There are none.
Okay, terrific. We'll move on to 3A. We have a relatively speedy meeting today, but we'll be sure to keep us appraised. We have approval of the minutes from the Finance Committee meeting from October 23rd. May I have any public comments on the minutes?
There are none.
And any comments, Diana? And if not, a motion, please.
A motion to accept the minutes.
Great. And second, and we can move on to 3B, which is our monthly financial update.
Good morning, Chair Smith and Vice Chair Mayer. My name is Brett Uppendahl. I'm the Finance Director here for the district. I have with me here today Greg Plum, who is our Finance Management Analyst in the Finance Department. He'll be kind of walking us through some of the slides towards the back of this deck as we get into some of the water use kind of insights that we've gained in the last couple months. But I will start off with just the standard monthly financial report here for the first couple slides. This is as of the end of October, and so that gives us 4 months in the overall billing periods. So it's essentially a third of the way through the year, and we've completed 2 full billing cycles. So it starts to give us a pretty good look at where the trajectories are going in terms of district revenues, particularly. Expenses are something as I'll talk about later, we'll be spending more time on over the winter as we get closer to that midpoint of the year. But for now, at 33% of the year revenues here, you can see across the top, water revenues are lagging in comparison to where they would normally be and slightly in comparison to last year. So we're 40% of the budget overall on water revenue. You can see there in the gray columns on the right. Last year we were at 42. So I think the board and then the committee would remember that last year we ended up the year a little bit short on our overall revenues. It was made up by savings and expenditure sides and other revenue sources we did have. This year it looks like we're tracking even a little bit shorter than that. So as I'll show in the next couple slides, it's something we'll have to keep a closer and closer eye on as we get through the year. Other revenues are pretty small, and a lot of that's kind of driven by when we get our grant reimbursement. So don't look at that line too much until we get towards the end of the year. But overall operating revenue, again, they're 40%, slightly lagging the overall expected budget at this point. Capital revenue, as we've talked about before, is typically closer to being in line there. At this time of the year, we fall a little bit behind the linear trend because we're waiting for our first allotment of fire flow taxes, and those will come in December. So we have our fixed kind of month by month here, getting us towards our revenue, and then we will add our fire flow and other revenues when they come in here closer to the property tax cycles. Expenditures, again, this has been pretty consistent the last year or two in the sense of, personnel services lagging a little bit from where you'd expect. We're kind of on a similar trend as last year, 29% of the way through the year in personnel services. So early indications would say that we'll probably have some level of salary savings again this coming year. We will look at that closer, as I mentioned, after the mid-year break. So in January, we'll take a closer look at where that's projected to come through. Maintenance operations, that one tends to lag, especially as we get closer to the winter time, because a lot of those costs are driven by electricity, purchased water, and then to the extent we need construction contracts, and then those will typically come through more in the spring and the summer as we get there. So I do expect some of maintenance operations to lag early in the year. We're a little bit behind last year, which is obviously a savings and generally a good sign, but we're in a comfortable area there. Again, more kind of projections on how that looks towards the end of the year will come in the spring. But overall expenses I'm pretty comfortable with. We're less than the 33% linear trend. Overall, we'll have a savings most likely in the operating budget. And we'll look into that, as I mentioned a few times now, in the next coming months. Capital expenditures are looking a lot better. You can see there we're 38% of the fiscal year budget, which is ahead of progress. And I know that we've been working hard to move a lot of the bigger capital expenses forward. So the engineering team will continue to award those contracts and be ready for the construction cycle next summer. I do imagine that we'll get quite a few invoices here from kind of the last tail end of October in terms of construction work being done. So this number should continue to rise in terms of overall expenses over the next few months. And that's obviously a good thing as we're reinvesting back in the water system. So as I mentioned, sales revenues are lagging a little bit, and you can really see it here in that far left column on the water sales budget to actual. We after a relatively kind of good month in July, we've now had three in a row at the 90% clip. So that's starting to push us towards obviously a 10% or so, 9 or 10% below our expected budget. You can see they're down on the far left bottom. Our percent of expected actuals is 91%. So that is, a relatively large number. If you think about the base here, our budget is 115 million in that category. So if we're near 10% below that, we're talking about a 10 to 11 million dollar shortfall in terms of revenues. Not a small number by any means, and so that's something we'll have to again keep a closer look on as we get through the winter. I would also point out that November and December, you can see there on the budget, those are expected to be relatively large, but then it tapers off quite a bit until the very end of the month. So it's harder to make up ground in this category in terms of, financial projections. After November and December, it gets to be a lot harder to make up any major ground in terms of overall budget. So we're likely going to end the year, relatively short here in the revenue column. As we get into kind of some discussion later in this presentation, we'll talk about some reasons why that might be. And Greg has a few slides that we'll go through on that. The other categories there are service charge and capital maintenance. Those are our fixed fees. Those are really close to 100% as we'd expect. And watershed fee overall is tracking a little bit closer to our expectation in the sense that it's 6% below, but that is also kind of another reason it's related to the variable use. And so that will be low in terms of relation to the budget because it's following this chart here. And this is our overall water consumption. And this is what's really driving all of those revenue shortfalls right now is that we are just below our overall, projections for the year, below our 10-year average. And as kind of in terms of bottom line, our overall water consumption is 7% lower than our overall budget this year. So in line with what the watershed revenue shows, and it's even exacerbated more when you turn in terms of our water sales revenue because we do have the tiers in place there. So overall, this is starting to show we're going to be shortfall. We'll have a shortfall this year, and I don't want to put any numbers to that quite yet, other than kind of broad ranges. But after we get through November and December, we'll have a much better idea of where that's headed. For the final slide here on our overall consumption, this is just, again, kind of a new slide we've added in the last 6 months or so, kind of tier by tier. And this one starts to kind of, become more informative as we get through the midpoint of the year. You can start to see it adds a little more information in terms of where we are kind of ending up. Although I would say that, the slides we're about to see in the next few are more informative. And so I'll pause there on just the financial side to see if there's any questions from the board before I transfer it over to Greg here to talk a little bit more about our actual use patterns.
Great. Thanks, Director Meyer.
No questions for me. Thank you.
So I'm curious, with the clear trend and the continued rains, which has a lot of benefits, how you're thinking about expense management, beyond just dipping into reserves. So what are the options?
So right now, as I kind of briefly alluded to, we're going to have a natural salary savings, which should roughly speaking, should cover for about half of that revenue shortfall. And so,
Is that from not
it's
hiring?
mostly from vacancies. Yeah, it's not from not hiring. It's just from the kind of the standard, there's a delay and a lag in the hiring process.
So conservative budgeting from a
generally
payroll
conserv-
perspective?
Well, I mean, I think we try to find a right balance there. I mean, we try to assume, most positions will be filled throughout the year, but the combinations of 5 to 10% vacancy rate add up over the year. So
Do you know how many open positions we have right now, unfilled?
I believe it's somewhere near 15.
Okay.
I can double check that and bring that back to you next month. But between 15 and 20 tends to be our,
Right.
kind of normal run
When
rate.
we got
on
in
them.
here, it was in 25 to 30, I think.
When you first started, yeah, we had kind of a much as you mentioned, we were intentionally slowing that process because we needed to generate savings,
Yeah.
and so we've kind of cut that gap about in half, I would say, going
Okay.
forward. Obviously, the goal is to have people here working, and so we're trying.
On LinkedIn, I only saw one position open, but
One posted?
maybe there are more. I'm not sure.
Well, I think we do post in various
It was
kind
like an
of
inspector job, I
avenues.
think.
Yeah, I think depending on the position and depending on the kind of the past history within the recruitment world, I think they
Yeah.
do have different strategies for each position.
Okay.
I don't know exactly how much are advertised right now, but I know there's quite a few that are in the works of being ready to be posted.
Right.
Sites,
Okay.
right? If we're doing internal promotion opportunities, right? Then what happens?
Then
is-
it'll open and then you go for it.
Right,
Yeah.
at some point, you
That's
go
cool.
out.
Okay. Understood. Okay.
Mhm.
And so then beyond just the natural expected payroll, then you have another $5 million, $6 million shortfall. So,
Yeah. And so, as I mentioned there, a lot of that will be kind of decided on, how much water we end up purchasing this year, whether or not we are closer to our minimum take or pay, or whether we have to, increase our take later in the year. So that's weather dependent, obviously, and that can be
right.
a couple $1 million in and of itself. PG&E bills are similar depending on demand. How high those go can be a million or two in and of themselves. And then I mentioned construction contracts in terms of the amount those add up to in terms of overall, expense can range in the million to 2 million range as well for leak repairs, whether they're minor repairs or major repairs, and how much the city requirements are. So the combination of all those adds up to another 3-ish million.
Yep.
And then, as I'll talk about in the next item, we also have investment earnings that are coming in better than expected. And so the combination of all those will put us in a manageable range. And then obviously I'll be working with General Manager Hornstein to kind of determine if we need to do anything in addition to that
Yeah.
as we get later into the year.
Terrific. Thank you.
Okay, so at this point, I'm going to switch over. I'm going to transfer the mic over to Greg Plum, and he's going to talk a little bit about some deeper analysis on our water use trends, and specifically in relation to what we expected 2.5 years ago in our cost of service analysis. I would also point out that this is an initial review that Greg and I and the team have done. At this point, we'll obviously be taking a much deeper view with the help of a consultant in terms of how this relates to forward-looking actions and any decisions the board would take. But this is kind of the preliminary look that the staff is taking in advance of working with a consultant to really take that deeper dive. So I would consider this just kind of an initial deep dive by staff, and we'll have more information in the spring. But Greg.
Good morning, Greg Plum, Financial Management Analyst. Pleased to be here today to present some of the water use trends and take a look at the previous cost of service analysis. So I would point out that while the previous information was, a lot of it was in acre feet, we chose to use hundreds of cubic feet, CCF, in these slides, just because it relates to billing data to keep it all in the same units. So the first chart here is just a look at total water consumption by fiscal year that we're used to seeing, and just to sort of see that trend that we've had since the drought, where things dropped, and then it was about 8.3 in fiscal year 22 million CCF, and has risen about 10% by the end of fiscal year 25. And we'll kind of now dive into sort of looking at this information in a few different ways just to understand some of the underlying trends. So now we're just looking at potable water consumption. So we've taken out raw water, recycled water, and looking at our primary customer classes of single family, multifamily, commercial and institutional, and irrigation only meters. So the chart on the left shows all 4 of those classes, and the chart on the right, we've just excluded single family so we can zoom in a little bit on the smaller classes. And we can see the percentages on the lines on the charts just show what percentage of our total water consumption is represented by that customer class for that fiscal year. And then you'll see a vertical dashed line, which is fiscal year 24, when our new rate structure was, in place and implemented following the cost of service analysis that took place the previous fiscal year, which itself was, a lot of it was based on data, which was fiscal year 22, which is kind of something that will be a recurring theme as we move through. Anyway, but we've seen a good rebound in single family use, and it's just above 60% of the total. On the right, the gray line is commercial, and we did see a decent rebound, and then it's flattened off the last fiscal year, and is about 13% of the total. Multifamily notably has remained relatively flat since the drought, and is about 20% of the total. And then at the bottom, irrigation, again, a similar rebound to what we've seen for single family, and is about 6% of the total. So that's the kind of overview by customer class. And then looking at the same data, but by billing tier. This was really just to sort of get the overview to see, as we know, with the cost of service analysis, we had some significant changes to the rate structure and the billing tiers to align them with those categories of water use. We had base water use, average, summer, and peak that were in the cost of service analysis, which led to a realignment of our tiers. Tier 1 was narrowed, and notably Tier 3 was significantly broadened. So we'd expect to see some changes as a result of that, and that's what we see here. So chart on the left is all 4 tiers. Tier 1 at the top, we can see has declined from about 80% to about 70% of our total potable use, which is in line with what we expected to see. And then looking over at the right, and just focusing on the orange line, which is Tier 3, that went from about 30 CCF in terms of how broad that tier is to over 50. So we expected to see a significant increase in that, and that has been shown. So it's now about 14% of our total tiered water use. Small changes in the other 2 tiers, which I'd say were kind of in line with the growth we've seen since the drought in water use.
It'd be interesting. Sorry, I keep asking for more analysis, but this is great. Looking at the number of households in each of these tiers, because I would imagine, although the tier percentage change, it'd be really interesting if the number of households has changed, right? Because Tier 3 probably now includes more homes than it did before. And so are we seeing a behavior change, or are we just seeing an impact of, rates on use?
It's definitely something we can look at.
That'd be illustrative. Thank you. Phil Sauter will like it.
Yeah. So before moving on to sort of look at how things are borne out in terms of projections from the cost of service analysis and actuals, we just wanted to pause and look at the weather patterns as we've seen so far this fiscal year. The weather's had a dramatic impact, and it was notable that the cost of service analysis was based a lot on data in fiscal year 22, which is notable because it was the end of a historic drought, but also we had a slightly unusual weather pattern. So we had this significant rainfall early in October, and then again, more significant rainfall in December. But then it was relatively dry in the sort of winter and very early spring months. In contrast, the subsequent fiscal years, we see what I'd say maybe a bit more of a typical weather pattern for us is light rain in October, and then heavier rains November through February, and then quite often sort of some significant rainfall in March, April, which can really change how those shoulder seasons respond in terms of water use. So on the next slide, we show bi-monthly potable water consumption for 3 fiscal years. So yellow is fiscal year 22, and then green and blue are 24 and 25. And just a few things to point out. I guess what we would expect to see coming out of the drought would be a slight rebound in each, as we do for July and August. So that's kind of what we were expecting. But because of these fairly dramatically different weather patterns, we saw significantly higher use in November and December in 24 and 25 than expected. And as we'll see, that maybe has impacted what tiers our overall annual use has ended up being in. And then in March and April, we saw significantly lower use because we had that later rainfall. And that has, I would say, suppressed a little bit the tier 1 use overall for the year. Okay. So now we're looking at fiscal year 25, the projections of the COSA for potable water consumption in million CCF, and by customer class, first of all, and then we'll look at it by tier. So the sort of overall we're at 98%. So I would say that's pretty close for, a model to be at 98%. So we're pleased with that. Looking then at the individual customer classes, just a few notable sort of things is that we saw multifamily had remained relatively flat. So that's a little bit below the projection. And then single family is slightly below, but close enough. So then looking at this a different way by billing tier, we do see that that tier one is where the shortfall is, and that the other tiers are a little higher. And this is really this sort of slight shift in the weather pattern that has resulted in different consumption patterns through the year. So I would say sort of in line with expectations, but it's interesting to note what a difference different weather patterns has on our tiered consumption. So that's water consumption, and then looking at water sales in dollars for fiscal year 25. So first of all, by customer class, so overall 96%. And we can really see the impact the multifamily had, relatively small dollars, but 92% is a significant deviation. And then the other two at 97%. And then finally, looking at water sales by tier, here again, we see the difference we noted earlier due to bi-monthly use patterns. Tier one at 91%, tiers 2 and 3 about in line, and tier 4 slightly higher. One of the things we've talked about before is that when we do a rate increase on July 1, is that there is a lag for that to come through in customer bills. And that's one of the reasons that this percentage is slightly lower than it is for the water consumption number. And so that's the big picture of water use. We also wanted to take a look at how the typical single family customer has been impacted, which was something that was presented to customers in the cost of service analysis on the website and in mailers that were sent to customers. And this table is what was presented. So when we talk about the typical single family residential customer, that customer has a 5/8 inch meter, which is the most common size. And at the time, median water use for all customers, single family customers, was 11 CCF. And so that then was used to make these projections. So the projected bi-monthly bill was for fiscal year 24, $170, which was a 23% increase. And then for fiscal year 25, the projection was $191, which was then a 12% increase over 24. When we looked at this, obviously there's been a rebound in consumption. So we wanted to recalibrate this, recognizing that median water use has changed. This chart just shows us how median water use has changed. So the blue line in the middle is our median residential customer with a 5/8 inch meter. And it's basically gone from 11 to 12. So it's gone up, but not too much. The other two lines show the yellow line is the 75th percentile, which has gone from 17 to 19. And then our 25th percentile in green has remained pretty flat. So we recalibrated those projections using the 12 CCF number. Next slide. So that's what you see here is the recalibrated projection for 24 would be about $175. And then for 25, it would be 203. And then the actuals below 167 and 199 are slightly below those projections. And the biggest factor that's causing them to be slightly below is really just that billing lag, the lag from when we do the rate increase to when it impacts bills. But we're, happy that we're seeing things, at the big picture and at the individual customer level in line with what the COSA was trying to achieve. So overall, really happy. With that, I'll hand back over to Brett to summarize.
Thank you, Greg. And so this is a summary of both kind of halves of that presentation. So the first part for the financials, as I mentioned, our rate revenues to the first 4 months are about 7% below our budget. The total water consumption mirrors that about 6.7% lower than we would expect, and about 7% lower than our 10-year average. We also are anticipating savings in terms of operating and capital expenditures. They're slightly below our overall budget. And as Greg just kind of ran through there, an initial review of our overall rate structure shows that, largely the revenues and the kind of consumption is within kind of a good range of where the model would show. I think it shows that, our revenues were lower overall, obviously. So we are not collecting more revenue than we expected. We're actually collecting less revenue. But despite the monthly variances in the climate and in overall demand, the consumption was pretty similar and within an acceptable range for the first 2 years of the COSA. As Greg mentioned, the median water use slightly increased for single family residential, our largest customer base, from 11 CCFs to 12 CCFs. And then, as you mentioned that last slide, if we look at the bills and how that actually pans out, the typical bills are about 2 to 5% lower than the expected median would have inclined, and a lot of that translates pretty well back to where we ended up the year in overall revenue. And as I mentioned a few times, the revenue was lower than we expected in the COSA, but we were able to offset that so far with other revenue sources and with expenditure savings. So far so good. As I would kind of high level summarize that in the sense that the COSA still kind of provides a useful overall projections and demand going forward. And I think this next year will really help inform kind of whether or not we need to make any major changes or just little fine tunings as we get into the next cycle for the cost of service analysis. But with that, I'll wrap up my comments and I'm happy to take any questions.
Great. Thank you. Thanks for the detailed report, Director Meyer.
No, I'm taking, Brett, that you don't sound like you're worried yet, and that's a good thing. So sounds like if we need to worry, we will make some changes. And I really appreciate this very, very in-depth analysis, super helpful. And although it's a bummer for us, I'm sure there are a lot of happy households out there because I just never cease to hear the end of the complaints about the water rate. So that's an interesting thing to think about too.
Great. Thank you for the report. Now, this makes me think about the fact that we don't have a full board here because I know all the other board members that aren't here have a lot of interest in this subject and the impact of the rates, the impact of consumption and pricing and tiers. And I'm just wondering, Ben, if you have thoughts about how do I summarize this? I wouldn't mind if it's possible to have some sort of full board presentation, and like maybe with 3 or 4 or 5 of these slides that show the revenue impact, the consumption impact.
Yeah,
what-
so
and
to,
drain. Yeah,
I was thinking similar, Chair Smith. One thing we can think about, we are planning at the board retreat to touch on a whole number of items, but one of them is the next rate setting process. So some of these would dovetail well with that.
That's
We
a great
can
idea.
put some slides together.
That's a perfect place to do it because I don't think we have another finance committee meeting until January, right? So that's a perfect time to do that, and then they can ask questions directly to you, and I don't have to give a very high level support. So 4 or 5 of those slides around revenues, consumption, uh, uh, rain, et cetera. But I really do appreciate the report and the analysis. I haven't seen it at this level, and it's interesting that we did raise the rates a lot, and we're still slightly under on revenues. So, how much of that is the fact that our customers understand the importance of not wasting water, or how much of that is the fact that it's just weather related and raining at different times, and the sensitivity analysis around that, I'm sure, is like almost impossible, but there's a lot of factors. So this at least gives us some more data and a lens into it. So that's all for me. Any public comments?
Yes, Mr. Phil Sauter, please.
Good morning. Many thanks to Brett and Greg and Tina for the presentation. I'm really glad to see the focus on customer segmentation. As we look at the differences between current results and plan results and between current results and prior year's results, it's so much more helpful to see which customer segments are contributing to those differences and to try to find the reasons why. Thank you for these deeper dives into customer data. I think these kinds of analyses will be useful in many areas affecting the district. For instance, we often shrug our shoulders watching the rebound in use after a drought. We haven't been able to predict how much the rebound will be or how long it will take. Any lack of insight could result in less than optimal decisions regarding supply requirements, projected revenue, capital investments, and opportunities for increased water efficiency. It's not that we don't have the data, we've got more than a century's worth. I think it's because we haven't previously seen the value of these kinds of analyses that Brett is bringing forward and Director Smith has been encouraging. we're now getting information on customer categories, and we can see, for example, that single-family customers are responsible for the spikes in water usage and for the declines during a drought and for the rebounds after a drought. In comparison, multifamily customers, commercial and institutional customers, are rock steady, drought or no drought. And irrigation customers have small swings, but nothing like single-family users. I think that's valuable information, and it could be even more so if we were to track the drought, post-drought swings by single-family user percentile or by location. Most single-family customers probably aren't going to have major swings, and I expect we could get some good decision-making information if we could break out those customers who are responsible for the large swings in usage and be better able to predict their patterns. We could, for example, use the data to optimize the layout for a recycled water system. Thursday, today's our broom pulling day in the valley, so I'll miss the last item on the agenda. Perhaps the topic of user analysis will come up later in the discussion of our SAP software renewal. It would be great if the software provider could let us know how other SAP users are using their software to drill down to better understand and affect their customers' behavior. Thank you again very much for the presentation.
Thank you. There are no further speakers.
All right, terrific. We'll move on to item 3C, which is our quarterly investment report. Thank you for the analysis, Greg.
Right. So for this item, we do not have a presentation. It is kind of a routine quarterly update on our investments. And so with the staff report, you can see that our overall investment income this month was just over $1 million, so about $1.1 million in overall investments. That does represent an increase compared to last year's first quarter of about $100,000, and it puts us on a pretty good track this year. Obviously, not being able to forecast rate changes from the Fed, but puts us on a pretty good track to be able to exceed our budget and probably have some additional revenue to offset some of the shortfalls we did previously talked about. You'll notice that in this month's report, we do report our first investments with the CAMP Pooled Investment Fund. And so we have moved $14 million into that category. And that is part of the reason why we're starting to see better returns, as the CAMP pool has given us about a 4.25% overall investment return. And so between that and our LAIF investments, we really are seeing some positive results. Notwithstanding the fact that we know that rate cuts are likely to be coming, sooner than later. I think the good news on this is that the LAIF pool, where we have the majority of our funds, around 75 million, that tends to have a longer tail, meaning that it will kind of retain the higher earnings because it has some longer dated investments there. So we should still continue to see a relatively healthy investments there, as well as some of the CAMP cash pools, in comparison to the short term kind of rates that you would see in the market. So we're expecting this year to continue to come in, relatively healthy in terms of overall revenue and investments. But for the time being, we have one quarter in, and we are seeing, like, as I mentioned, a little bit higher revenue than we saw last year, and it puts us on a good track for the current year. Overall, district pooled cash into the quarter with $115.3 million. And the average effective yield for the first quarter was about 4.35 in LAIF. And so it's a slight reduction in last year's yield for the LAIF investment themselves. But as I just mentioned, we have our investments in a couple different areas that are making up for that shortfall. So overall, good news here, and continued kind of, buffer for the district's revenue in the sense of coming short on our rate revenues for the first quarter at least here. So happy to take any questions on this, and we will be doing a bit deeper dive on our investment policy in the spring next year, as well as we do every year.
Perfect. Great. Director Meyer.
No, I'm all good. I was just gonna say, Brett, going back to kind of some summary that we're gonna do. It sounds like we're gonna do in the board retreat, which is great. It would be awesome to get, and maybe not right this minute, but in the next few months, also some talking points when we're talking to people in our district. What's going on with rates, what its impact it's having, that kind of a thing. I always get lots of inquiries about it, and thinking about what's the difference between internal messaging and external messaging would be good.
Great. Any sense of how much our change in investment policy impacted the better returns here? Is that in essence the non-LAIF investments, or do we make the right call? Are we seeing the impact of it?
I mean, I would say we definitely made the right call. LAIF, the investment through LAIF, which is the local agency investment vehicle for all California agencies, that has a cap of 75 million. And so essentially, once we got past that cap, as we kind of increased our reserves, we only had it in short-term money markets, and we were limited in certain percentages of the portfolio on how much in the money market funds we could use. And so we really had a lot of money, kind of making less than the ideal interest rates. By getting into camp, we kind of freed up, in this case, $14 million, and it'll be more in the next quarter to be able to make significantly higher interest rate earnings. And what I'm looking at here now is it's about, between zero point 0.3 and zero point 0.5 basis points that we're getting extra on camp than we would have otherwise just in the short-term pool. So definitely a good move.
Got it. Great. And do you have a balance of short and long term in investments here, or how are we thinking about that, or is it all trying to be as liquid as possible?
Well, one of the main goals of the investment policy is to have liquidity and safety, and so the vast majority of our investments are in very very short term, very safe, very liquid vehicles. LAIF does provide a nice balance there in the sense that they have some longer dated, I think up to 5-year maturity vehicles, so that does help you kind of have some of the longer locked in rates, and they do provide liquidity and safety up front. So that's why so many agencies use them. Camp is very similar. Right now, we're in the camp pool, which is kind of a much more shorter term look at that. There is an option to go into some of the camp term investments, which would help us long date some of those. And we may need to look into that as the yield curve changes in the next 6 months to a year. But for now, we're on the right side of it. So we're not looking to any major changes yet. But essentially, we're 5 years and less for everything that we have. And
Yeah,
it's all.
I'm not I'm not into betting on where rates are going, but I do think having a balance of maybe some more longer term investments would serve us well, be a conservative way to go about it. So obviously we have to have liquidity. So I'm sure you'll figure it out. But I look forward to looking at the policy again in the spring.
Will do.
Okay, great. Any other public comments on this?
There are none.
Okay, terrific. Moving on to item 3D, SAP software renewal. Nice timing.
All right, so this is the third and final item we have on the agenda here today. And with me, I have here Brad Taylor, our IT manager. And this is a relatively routine approval item. This is for our SAP software maintenance agreement. And so just to clarify from the public comment earlier, this is not renewing our entire software. This is just the annual maintenance agreement we do through SAP. And I'll kick it over to Brad here to explain what this is for.
So this is a little bit simpler than last year. Last year, we reinstated our SAP support and maintenance, which means we actually had to pay a reinstatement fee and negotiate sort of some credits back from SAP, and then basically get off of a third-party support contract that we had pursued with Rimini Street. This is just straightforward renewal of the 2025 maintenance contract to extend it through 2026. And we are anticipating that the payment will be about 196,000. There may be an increase in that based on SAP's just adjustment of their software pricing year over year, but it should not exceed 216 or so thousand. And this gives us access to SAP updates. It gives us access to SAP support, allows us to actually log tickets if we have any issues or bugs that we run into with the SAP system.
Got it. Any questions, Director Meyer? I'm curious. I thought that they were not supporting this anymore. So did they decide to continue to?
2027 is there. Yeah, and it's not. They're not going to withdraw support, but it will be deemed end of life.
Yeah.
In 2027, and at which point the costs for any sort of support and maintenance we actually will have to pay a premium. They're anticipating probably about a 15% increase.
Okay.
Now, SAP in the past has sort of kicked the can down the road.
Yeah.
It's quite possible that this could get extended again.
I would imagine people would want it. And did I see those dollar numbers in the approval that we have here for the renewal, or is it just, you just quoted them verbally? I'm not sure I saw them in the.
Yeah, they're in the staff report.
They're in the staff report. Okay, great. And when are we going to have an update on the SAP and the whole ERP system upgrade? What's the timeline looking like? Is that also a retreat item, or is that another report out later?
So I can touch on it briefly at the retreat. We will have a couple items for the board to essentially review and potentially sign off on in terms of what we need to start signing up for in the new SAP environment. And so in the S4 cloud environment, we will start to have to purchase our entitlements. We're working with SAP right now to kind of decide. They basically have a huge menu of all the different kind of SKUs or products that they can sell us. We're actively working with them now to determine the timing of that, which ones to use first and not. And a lot of that is it's kind of real time as we're kind of investigating or looking into the requirements for not only our billing systems, which is the next phase, but also as we get into work orders and the overall kind of finance underlying financial ERP. And so we're working with them on literally a weekly basis to kind of refine those estimates and to refine the pricing and the timing, especially on those. And so we can give a much bigger or kind of broader update likely in January or February as part of kind of our recommended next steps with procuring some of those entitlements. And I'm not sure if Brad, if you have anything to add to that.
Well, that makes this, that summarizes it well.
Yeah, I think I had another realization of how archaic our system is when I bumped into an inspector in Mill Valley who was sitting in his car working on paper write-outs for his reads. And I had a really interesting long conversation with him, and it just seems like the system is full of potential human errors. Paper, write-ups that end up having to get put into a system where I gather we only had one computer in the office where the inspectors could input their data, and then that computer was getting used. So people had piles of or days of reports to enter into the system, and then they'd have to take time away from actually doing the work in the field. I mean, this should all be on remote mobile devices. It should be buttoned up from a data perspective. So hopefully we've got another computer for those folks to input the data. I'm sure that would save hours of time. This is really, really important work to upgrade our agency to the 21st century. So it's just a comment. So that's maybe a nudge.
No, and I would just say I fully agree. I think, it's as we're going through each individual work group and how they interact with the current SAP system, it's clear that there's, a lot of efficiencies to be made.
Yeah.
There's a lot of processes to improve. And I think our staff will be, after the conversion will be much more efficient and effective. I would want to clarify one thing though in terms of our meter reading staff. And so they have a couple different tasks when they're out there. When they're doing their normal reads, the kind of day-to-day type reads, we do have mobile devices for them to plug
Yep.
into. It's when they do more of the specialized work and some of the kind of
Yep.
special jobs that's when they do revert more to paper-based. We just finished a kind of a deep dive session with the meter shop in the last month or so to kind of really highlight that. And I think Raj is here in the background. I think we were all it's eye-opening to see how many areas we have for improvement going forward. So it's exciting in one sense, and we're looking forward to really bringing that to the district.
Having it happen. Okay, terrific. Any public comments?
There are none.
All right, I think we are all done with that. So our next meeting is, when is it? January 22nd. Thank you. And
Tentatively scheduled.
pending approval of the calendar, which
Yes.
we'll review with the board, but it looks like it'll be in almost 2 months. So thanks again. Thanks, team. We are adjourned.